All right, I got to start with the news of the day. Really ugly jobless claims figures, 965,000, a big jump. Even if the numbers are as somewhat distorted as people have said, do you believe they're telling an accurate story of the economy right now, and what does it mean?
I actually believe the pain that we're seeing in the labor market is greater than a simple number like jobless claims. And the jump that we saw, we can quibble about this number or that number, but the jump we saw isn't really unexpected in my view. When I talk to my contacts in communities, businesses, health experts, they confirm, and you see this in the mobility data, as goes COVID, goes the economy. And these are real people without jobs, maybe even outside of the labor force altogether, trying to cope through what is really a terrible pandemic.
Do you anticipate that it will work the opposite way? That once the numbers start to go down, the curve bends, vaccinations rise, people will get hired back quickly?
Well, we saw that in the early rebound when we could come out a little bit in the summer, that people did rebound and businesses did hire back. But the truth about COVID math is the longer it goes, the more damage it does. And so we are really going to need to work hard to get as many workers back in out of the gate, of course. But remember that we have a big hole to dig out of, and it's probably going to take some time to fully get everybody back to work.
Some people have suggested that scarring will be bad enough it will take 2 or 3 years for that to happen.
Well, it could take 2 or 3 years, but that's really up to us. How quickly do we start to re-engage? How much support do we give people so that they don't have to start over? We all know that if businesses have to start from scratch, that causes more delays than if we can keep them afloat during the crisis and have them rehire their workers once COVID is behind us. So the stimulus plans, the fiscal support more generally, the support we're getting from the Federal Reserve that we're giving, these are all meant to get as many people bridged over the virus as possible and have that rapid start that we all really want and we depend on.
Well, where do you stand then on the question floating around the markets these days, the idea the economy can come back relatively quickly, and so the Fed will start tapering its QE purchases by the end of the year or early 2022?
Well, let me try to rectify, I think, a common confusion. The economy coming back quickly does not mean that we're victorious in terms of attaining full employment and price stability. The hole that COVID has dug is so big that even with rapid growth, it will take a couple of years to get everyone who was out of work, sidelined, all the millions of women who have had to stay home and take care of their kids coming back into the workplace. These are going to take some time. And so rapid growth is a good start, but it is not a full victory.
All right, that leads me to our next question, your forecast for the year. Let's start with growth. We get additional stimulus recently, and apparently President-elect Biden's going to announce more tonight. What do you see for 2021, and how does the fiscal side figure into your forecast?
Well, I'm bullish about 2021 overall, and that's really dependent, though, on COVID. We've got some really hard months ahead of us, and I hope it's really just months, but it could be quarters. We've got some really hard months ahead of us, though, in terms of fighting COVID, getting the vaccine distributed, getting people healthy and ready to go back out and re-engage. When that's behind us, I do expect a rapid rebound. I saw that in the previous time when we could come out last summer. I see people, they want to get out. They want to partake in activity, but they want to do it safely and they want to do it without worrying. So when that happens, I have a sense that 2021, the second half, is going to be a robust growth. But I want to remind everybody, it's a deep hole. So even with robust growth, we're going to take some time to fully dig ourselves out of it and get back to where we were prior to COVID.
Well, do you have a year-over-year GDP forecast for the fourth quarter, and is that influenced by what President-elect Biden may or may not get accomplished?
So fiscal support is important, and I don't want to put a number on year-over-year growth. We do have to do forecasts, but we're still in this mindset that there's so much uncertainty about when we'll start that we're really just thinking about where we're going to go over the next couple of years and what's important for us to get there. When I think of fiscal support, I think of the length of the bridge. That's how we think, that's how we do this, right? We need a bridge that gets us fully through COVID. Millions of Americans are still sidelined. Millions of businesses still need help. So that bridge needs to be long enough. And of course, we also need to start to pivot, in my opinion, a pivot towards how do we think about infrastructure investment? How do we think about creating opportunities for the future? Thinking about education, thinking about digital infrastructure, thinking about physical infrastructure. These things have to be invested in if we're really going to have a strong future.
Well, reports are the Biden plan is going to cost around $2 trillion. Is that the kind of ballpark figure that you would see necessary?
Right now, I'm going to let Congress and the president-elect debate the actual amounts here. Really, what I focus on is how long is the bridge, and also what are we investing in? Supporting our individuals in the economy, supporting businesses, and then, of course, pivoting towards thinking about infrastructure investment that makes sure that we can all inclusively come back to a better future.
Well, that brings us back sort of around to where we started. What's the toll for the bridge? Investors seem to think that all this additional money that's going to flow into the economy is going to create inflation. What's your view?
A little inflation right now would be a welcome thing. Remember, we came through a 10-year expansion where we couldn't get inflation up to target. I'm more confident now that with our new framework review that we released in August and with the support that we're giving, that we'll get inflation fully back up to 2%. But I am not at all worried that there's this run up in inflation around the corner that we will need to preemptively stave off. That is actually something that I think reflects the scarring we all had. If you grew up in the 70s and 80s, you remember that. But we've had so many decades where that hasn't been true that right now my focus is fully on getting inflation back to 2% on average and eliminating the employment shortfalls that are pervasive in the economy right now.
Well, we're seeing strong personal income, particularly because of government transfer payments, but we're also seeing a big rise in commodity prices right now. We're seeing in the ISM reports rising prices paid and prices received. Do you think we get over 2% this year, perhaps to 2.5% in 2022?
It's quite possible that we'll see some spikes above 2%. In fact, the math of inflation would suggest we'll get some spikes in the middle of the year, but that's not a victory on price stability. Our price stability goal is 2% inflation on average and sustained modest overshooting of our 2% target in good times so that we can offset the times when inflation's really been below target. So I would expect some spikes above 2% this year, but getting fully to price stability in the way we've defined it, I don't expect that this year and probably at the latter part of next year when it comes.
Well, let me try to wrap what you're saying into a policy prescription. Is it the best thing for the Fed to do to sit tight this year where you are with asset purchases, where you are with interest rates, or is there some other policy that you feel might be necessary before the end of 2021?
Well, I've been very vocal right now about seeing policies in a good place, but we're a data-dependent Fed, and so we're looking at both what's the upside potential for the economy and what are the downside risks. For now, I see policies that are in a really good place. Interest rates, asset purchases, where they need to be, forward guidance, where it needs to be, directing people back to our statement and all of our communications that really say we're in this with all of our tools until the economy is fully through COVID and back on track, fully back on track to achieve the dual mandate goals. That's a good place in my judgment.
Speaking of all of your tools, do you think it's unfortunate that the Treasury Department ended the Fed lending programs, or are we finding out that at this point they don't seem to be necessary?
I would have preferred that we had the full slate of our lending programs until COVID is fully behind us. But that said, we still have many tools at our disposal and we're fully utilizing those. And the economy seems to be functioning quite well on the idea that if it would reemerge as necessary, we would redeploy them and Congress would take up that effort.
Shifting gears just a little bit away from COVID now and interest rate policy, former Fed Governor and Deputy Treasury Secretary Sarah Raskin wrote yesterday that the Fed should be prepared to do more under a Biden administration for climate change. Where do you think the Fed's responsibilities are there, and what can you do?
Well, you may know that in San Francisco, we've long been studying this, and you see this across the system, really long been studying climate risk. What are the risks of severe weather events? What do they impose on the financial system, on the broader economy, and importantly on our communities? Where are the losses? Where are the things we need to think about? And we've been actively studying that, and the Board of Governors was working on that. So I think collectively we are doing what we need to do, which is studying how that's additional risk to the economy that we need to be prepared for and think about ways to mitigate so that we can best serve the American people on our key responsibilities, which are monetary policy, a stable financial system, and a stable and sound payment system.
Now, the President-elect's program is, we're told, going to be aimed in particular at communities of color and other minorities. Are you in favor of changing the way the Fed does business to incorporate things like that directly, say targeting the black unemployment rate or something like that to try to decrease income inequality?
I've always believed, and I think the evidence bears this out, that having a dashboard of indicators, not a single indicator, is the best way to have inclusive growth. Think of all the groups that are sidelined regularly: people of color, black and brown communities, women, lower income individuals, people in rural communities. All of these individuals need and want to be part of the economy. And so I would be really worried about picking a single number when we have a dashboard of numbers that we should be looking at. I would like to see the black unemployment rate go down, but I'd also like to see wage growth for black workers go up. So I am reluctant and don't think it's a good idea to pick any single number. Let's actually pick numbers that do what we want to do, have an inclusive economy with inclusive growth where everybody gets a chance.